So the S&P gained 85 points to finish off the week thanks to Fed Chairman Powell trying to make up for the losses that maybe he feels he created coming out of the FOMC meeting in December. But that comes after a pretty decent loss yesterday, and before that a pretty decent gain. So big moves, all very, very typical of the type of environment we're in. I'm going to break that down in today's video and how that relates to our expectations going forward. We're also going to take a look at a stock that's made a nice jump finally after months of being weighed on, potentially making a little bit of a reversal. So we'll talk about that and how to trade it. So let's go ahead and get started. Today is Friday, January the 4th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. As you can see here, we did jump up above 2,500 today. Finished up at 2,532 essentially, above the highs here. So good bullish close. The near-term line did get below 50 yesterday. Remember, the near-term runs on the blue line above 50 are shorter when the intermediate line is below 50 than it is when it's above 50. So keep that in mind. We aren't back up above 50 yet. As bullish as today's move was, the near-term line still there. You can see the momentum line again spiking above 90th percentile, which is an extreme to the upside. It's 5th percentile to the downside, 90th to the upside. So that's a good bullish close for the S&P 500. Now, in my technical analysis class today at Market Scholars on the website, we spent the whole class talking about how the markets behave when they're below a 200-day moving average. And what we're seeing here, especially after such an extreme, right around the options expiration in December and the holidays, we're getting very, very typical price action now, as we've seen in previous instances when we're below the 200-day moving average. And so, you know, what that means now, you know, ultimately what that means, and in that class I broke that down into detail, but just in general, the idea is it's not going to be a straight shot to 3,000 from here. You know, there's going to be some resistance up in this area. We might get another near-term run up above 50. In fact, you would expect it to based on how we finish out today. More than likely, the near-term line is going to follow the momentum line up into this area. But don't expect, you know, a typical 7 to 12-day run. And there's going to be some resistance up in here, whether it's the 50-day moving average or Fibonacci retracement. The nice thing is we did close above the 30% Fibonacci retracement of this decline. See, we were sitting there at the 50% Fibonacci retracement, and then those 3 days around options expiration, Thursday, Friday, and then Christmas Eve, it was a big, sharp sell-off with a lot of volume that in 2 days we essentially reversed. So it kind of shows how fluffy that move to the downside was. Similar to how fluffy you can get fluffy moves to the upside. As we saw in January of last year, you can get fluffy moves to the downside, and they're quickly and easily reversed as we saw here. So we had come down to the 38% Fibonacci retracement right after the Fed meeting, and we're back up above it now. So it kind of reversed all that fluffiness, that holiday fluffiness that we saw. The posture is back to being bullish, the weekly bullish. So don't put all your eggs in the bullish basket yet. Eventually, there's, you know, on the intermediate basis, there's good opportunity here. But in the meantime, in the short term, there's going to be some choppiness to the upside and the downside. A lot of times coming off extremes, you see divergent low points. Even if we just come down to 2,400 with much higher lows on these oscillators that shows some extremes, you'll see in a second. That would still be a major type of divergence, and ultimately would lead to a break above the 200-day moving average. But until then, while we are below the 200-day moving average, you are going to get the biggest days, the biggest up days that you'll see, right? Because, you know what, Ryan Dietrich posted on Twitter that 24 of the 25 biggest up days have been with the S&P below the 200-day moving average. So we'll get bigger up days like we saw today, you know, practically a 4% move, 3.5% move on the S&P. But we'll also get normal size. When I say normal, I mean normal to the higher ATR that we currently have. we'll get normal size down moves too, which will be bigger than what we're accustomed to when the markets are really bullish. But right now, they're typical. Bigger moves are typical. Just like yesterday's move was very typical, and we discussed that in the portfolio management class I did yesterday. But today's move is not very abnormal either. We just get bigger moves when the ranges and volumes and trading ranges are higher as they are right now. Let's take a look at some of these other indexes here. The Dow Jones looking very similar, similar posture. The Nasdaq Composite had a nice good rally, 4.25% move higher. Similar pattern on its market forecast, and then the Russell 2000 3.75%. Very similar move as well. Didn't get below 50 on this near-term line. Didn't have as big of a drop, but also has a weaker bullish posture on the intermediate line. So as usual, when you have big declines, the correlations get close to 100%, and the market forecasts look very similar. It's when we're really bullish, the correlations start to fall closer to 0%, and you start getting different patterns, as we saw with the Russell showing weakness earlier than what we saw in the other major indexes. Alright, before we look at some of our other charts in our routine, a reminder to subscribe to our YouTube channel. Mouse over this logo right here in the bottom right corner of your video. Click that red subscribe button that pops out. Also, click the thumbs up icon down below the video. We look at that number to see, we look at that as a way for you to tell us that you want us to keep doing these videos. So if that's the case, click that thumbs up icon. If it's not the case, then you don't have to click anything. Really easy way for us to get feedback from you on these videos. Also, further down below, comment on what you got out of tonight's video. What was something that stood out to you that you picked up? We want to hear that as well down there. Join our Daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link. Really easy way to subscribe. Follow me on Twitter for more content like this in between videos throughout the day. And join our Market Outlook community that we created on Facebook. Also, a quick reminder that you can watch our Market Outlook videos on our blog, as well as some commentary that's posted along with it. Here at the top, you can discuss the Market Outlook with other market scholars in our forums. There, you have to subscribe to do that. You can do that for free up here, right in the top right. There's our calendar of our upcoming classes next week, starting a new full week of classes. You can see all of our classes by going to the Events tab. And remember, too, you can also like our Market Outlook videos on Twitter and Facebook down below the video here. All right, now let's jump back into some of these other charts. Here's how the week ended on so another relatively long lower shadow, relative to the body here. But you also see how we closed up above that 50% or 38% Fibonacci retracement. So that's positive, but you see we're still below the 50-day. Usually when you get extreme moves below the 200-day moving average, the first area of resistance it hits is the 50-day moving average. That's looming right around 2,600, which is also a big number. Keep that in mind. Of course, the 200 at 2,700. Probably won't touch the 200 until it falls a little bit further. After, as you can see on some of these, after forming a divergent low point, after touching the 50-day moving average. So we'll see. Right now, I believe we're in the mode of moving towards the 50-day moving average before we hit a new divergent low point somewhere below that. And again, we don't have to follow the patterns that we've seen in other instances below the 200-day moving average because just as headlines have driven a lot of this selling to the downside, headlines can also reverse a lot of that selling back to the upside, depending upon the headline, right? So, but based on past performance, we've seen resistance at the 50 before a new low was formed, and then it makes its move back to whether it's a new higher low or slightly lower low, which is a divergent low point, or whatever the case. That's what we typically see. If you look at the the 3 green arrow chart, of course we still only have the 2 green arrows. We're well below the 30-day moving average. We are in fact testing the 17-day moving average, and remember the 50-day is also just a little bit above the 30 at 2,600. So that's your next stage, right? You get above the 8, you test the 17-day. If you get above the 17-day, you start testing the 30 and 50-day moving averages, and then the 8-day will cross the 17-day, and then both lines will cross to 30. That's kind of your stage by stage look, but you typically don't get that until you get a new low point. Again, you can see various examples of that. In fact, if we were to go back here and look at the 2016-15 area. The last time, see, this would be summer. So here's 16 again. You can see how we got above it. We got to the 8, we got to the 17, got a little bit above it. Formed that divergent low point and rally. We touched the 50-day was actually right there, because we did touch the 50-day there. Same thing here. We touched the 50-day here. In this case, we got to the 30, formed a new low point. Then we got the crossover, just like we got the crossover there. You notice the 8-day on both of these crossed the 17 about the same time that both lines crossed the 30. So that's something to keep an eye on there. You see MACD is above 0. When it's coming off extreme lows, it usually will make a run towards 0 before forming a new low point and then blasting up above 0. And you've seen that in other cases too. You get the higher low point, then we blast through. So right now we're in the mode of moving towards 0. I don't think necessarily that we'll reach extreme highs on this current run. I believe we'll form a new low point next, and then blast through 0 and get up to strong bullish momentum to the upside. Alright, now as we look at the intraday moves, you can see nice good gap to the upside. We closed, we got it early in the day above yesterday's high point, retested it early, got up to last week's high point, stalled, and then got through it and couldn't quite get through it by too far, but held it for support on the way back down. We're trading right around the midpoint, the new midpoint. See, the high, the 4-week high has moved down. It was at 280, it's now to 271. So we got a 41 point. Still well above 10%, but you got a 41 point range here, and because the top moved down, so did the midpoint. So now we're trading at it. We were below it, now we're trading at it, and you can see a move up to 260, which is where that 50-day moving average is, would get us a move into the upper half of the 4-week range. And again, remember, this will come down a little bit more, and it will gradually keep coming down. And that will continue to lower this. In fact, the 4-week range will move to about 260 in about another week. The high point of the 4-week range will move to about that level within another week. So, keep that in mind, that a move to that area and then back down won't necessarily be like, it won't necessarily be like this kind of, why are we getting to that spot, right? Because things will start, this will start moving down, this will start moving down, and then move back down towards what will be the new midpoint, which will be lower at that point, will be expected, right? Will be kind of an expected thing. If you take a look at the volume today and the trading range, so this one, and then we'll go to SPY. Remember, the trading range includes, it's only 6 points, but it also includes about, let's see, we closed at 244.25. The low today was 247.25. So about 3 points we got to add to that. So we had about a 9-point range when you include the gap in the morning. So well above average range. Almost a 4% move. So big move. There you can also see too, the volume was 140 million. You get the big volumes right when you get the surge, and maybe a day or two or bounce up higher. We've had that, right? There's our surge, and we had some good strong volume on an up day, and then now it's very typical for us to go below the new higher average, right? And so we'll see, you see that here in some of these other examples, and that's where we're at. So we don't expect big volume on big moves like this. Simply because we've already had it. Right now we're going to start tapering on that volume. If you look at the volume at 140, it's still close to the average, which is still very high. The trading range today at 9 points, well off the charts. Here, excuse me. And that's keeping the relative ATR in that 2.5% area. That's a high number, and that does make you concerned a little bit about, once we do retest the 200-day moving average, whether we will fail at it and then start the bear market, right? Similar to early 2008, similar to late 2000, early 2001, where we made a move toward, broke down through, got the death cross, made the return move back to the 200-day moving average, and then the bear market started, and we fell off the cliff in summer of 2008, fall of 2008, and then also the late summer, fall of 2002. That's when things really hit the fan. We set the lows and started new bull markets. So That's still a possibility, and it's a possibility because the trading ranges here got so big, got to that 2.5% mark. Usually, when we're not starting bear markets, they stay capped about 2%, like this decline did. This one originally had stayed capped to 2% until we had the Fed meetings, and we broke down there in December, mid-December, and all of this had really large trading ranges that pushed the average up to an uncomfortable level, and showing that there is not necessarily a 100% or high likelihood that we'll fail at the 200-day moving average, but a decent enough that we have to consider it as a real possibility. Let's look at the volatility here. Again, the volatility is really dropping. So as low as we are below the 200-day moving average currently, as high as the ATRs are, the volatility is not very high. So again, you remember, over here, our volatility right now is as high as it was back here when the ATRs were capped at 2%, and we're at 2.5 now. So yes, we did jump up to 35, but we jumped up to 35 over here too. Jumped up to 40 and all the way up to 50 on an intraday basis. So volatility is a lot lower here, and you see what you typically see when you have reversals in volatility, long upper shadows, right, on these weekly charts, and we're getting that now. We're getting a long upper shadow. Last week and this week was a really significant decline, and we're dropping back out of extreme levels back down to normal levels for the type of trend that we're in, this type of a bearish drawdown that we're in right now. The bullish trend won't take hold until you break below this 90%. So look for support and volatility at the 95%. For those of you who like to buy volatility, like in inventory style trading, and also look for support at that 90% as the volatility moderates from this big surge that we had in the last couple of weeks. All right, so to summarize, we're in a bullish move right now. It's not a bullish move that will start a new intermediate trend, but it's in a bullish move that will get us back to that will stave off the selling, the sharp selling and the surge and volatility that we've seen. Will set us up for a move towards resistance, 50, 200-day moving averages, before we set up, most likely within the next couple of months, based on past precedent, another low point, somewhere probably around this 24 to 2500 area on the S&P. And then we'll start the typical 1 to 3 month intermediate run, and with market sentiment line as low as it is, multiples of those into the most of 2019 would be the expectation. So what do you think? Do you agree or disagree with that? There's a poll popping out. Click that link up there. Then it opens up a poll. Hit either agree or disagree. If you click disagree, scroll down to the bottom, comment down below. What are you seeing that would suggest otherwise? I know everybody's got their opinions on what they think the market should be doing or want it to be doing based on how they're trading. But if there's something that you see that you would want to share with the community, we'd love to see it in the comment section down below. All right, let's take a look at what's going on here among the major asset classes, what's driving the markets today. Of course, the biggest move, you have growth stocks in the S&P, small cap stocks, mid cap stocks, so very broad-based buying today. All outpacing ACWI, so U.S. outpacing emerging and developed, and both of those up 3% too. So it's not like they didn't have a big gain. Crude oil had a nice little bounce. It continues. I mean, look at the move here from Christmas Eve. And Christmas Eve, when it hit the rock bottom from 1226 on. In fact, if I were to customize this and look at 1226 on, here we go, and we'll change that to 10 minutes. Then you'll see, I mean, crude oil is up 12, almost 13% during that time frame. Well, let's see, I need to go, the problem we have here is 1224 was a half day, so it's you don't really see it as well here either, but you get the idea that the way that this coding is set up, you have a half day, so you don't really have that close at the right time. But you can see we were down 8%, we're up 4%, so about a 13% gain in crude oil. Some of these other aspects, you look at the S&P 500, it's up 3%, but it's coming off a 5% decline, so it's up really good too off of that Christmas Eve low point. Preferred stocks also making a decent run. Agricultural commodities and the dollar have been really weak. during this time. Again, most of that weakness was on Christmas Eve, but from Christmas Eve on, relatively flat while everything else is gaining. Treasuries are gaining too. So let's just look at just today here, and we'll look at a 10-minute glance at that. So there's the gap we had to the upside in crude oil. Off of its highs a little bit. You can see all these equity asset classes out gaining. There's preferred stocks with a gain too. High yield bonds is really performing well. And then all your safe havens. So very predictable move here. A lot of this coming from Fed speak. Chairman Powell spoke today and talked about the idea that he will hold off on, maybe even hold off on reducing the balance sheet. But also potentially hold off on interest rate hikes. So what that's done to the Fed funds rate, so here is March. So before today, and before the other big news of the day was the employment report. Here is, let's see, where's the employment report here. We were expecting 180,000 was the expectation for the jobs number. We got 312,000. Unemployment rate actually rose from 3.7 to 3.9, but the participation rate rose too, and that's why. Right? Again, you're not counted, this is a survey, and you're not counted as unemployed unless you are not working and you are currently looking for work. There are other unemployment rates that include marginally attached workers to the labor market, but this headline just looks at whether you are employed or not and whether you are looking for employment or not. And if you're not looking for employment, you're not included here in the participation rate, which impacts the unemployment. So yes, the unemployment rate rose, but only because more people started looking for work. The participation rate rallied, rose up here. The average hourly earnings rose, and so did the average work week. This is the aggregate weekly hours worked is one of the indicators that the Fed looks at on a leading basis. It's continuing to move higher, and so it's showing, you know, good bullish. You can see the impact it had on the economic surprise index here. If I were to scroll down, you know, we did jump up sharply. We were really sharply low after the ISM yesterday. It jumped up big time. But the biggest impact that the jobs number had was that it reduced the odds that we'd get a rate cut. So here was the odds yesterday, here 15.4% of getting a rate cut in March at the next, you know, quote unquote on meeting. 15%. So now that's gone. We're not going to get a rate hike. You know, the market's gone from an 84% chance of nothing to now a 99% chance. You can see in June the odds of us being here at the current levels are 94. But as of yesterday, there was a 25%. There was a 1 in 4 chance you're going to get a rate cut yesterday by June. Now the odds have gone to 0. Right. So the really strong employment report has pretty much nullified any odds that we'd get a rate cut. Now there's still about a 1 in 4 chance that we'll get one by the end of this year. 2019, but yesterday it was close to 50%. It was pretty much close to a coin flip that sometime next year we'd get a rate cut. But you also notice that the odds of a rate hike had gone to 0, and they've bumped up to 4%, and that's it. So there's still very, very negligible odds that we'll get a rate hike in 2019. So that's kind of the Pollyanna. That's the best of both worlds according to the equity markets. Right? Yields rise because the Fed's not going to lower rates. They were falling with inflation expectations, but the rate hike odds aren't increasing. That's what's been putting pressure on stocks. So they stayed muted, and so the stock market was able to rally because of the dovish Fed comments that came out. So kind of two things that both could have been very hawkish for the economy and rate hike odds, but neither one of them. We kind of got the best of both worlds, higher yields and higher stock prices. So if we take a look, this is the 5-year forward inflation rate expectation. This has been updated. Let's see, it's been updated as of the 2nd, which would be Wednesday. But still, you can see how much it's come down. That's why, despite the very strong employment report, the rate hike odds are not rising. They were falling because of this, because the inflation expectations were dropping like a rock. And they're not bouncing yet either. So there's the reasoning behind this Pollyanna situation where bonds fall and stocks rise, because the market got good economic data, but not to the point where the Fed will start thinking about raising rates yet, at least according to those who place their bets on those expectations in the futures market. All right, so in terms of sector performance today, not surprising. In fact, we dove into this quite a bit when we talked about how sectors perform when we're this far below 200-day moving average in my Thursday portfolio management class. And you can see technology, communication services, both had strong moves up higher. Industrials, materials staying up strong too with a relatively muted dollar. There's energy. You can see discretionary up, kind of matching the market. And everything else, all your safe haven areas up on the day too, just not up to the same extent. As you can see, this is from the October peak. By the October 3rd peak, the big declines we had in a lot of these areas. Energy with the biggest decline, down 30%. Technology and industrials were down 24% at its worst level on Christmas Eve. From those highs, discretionary was down 20%. Materials and financials were also down close to 20%. Healthcare was down, but not to the same extent. These were all down because of the Christmas Eve move. But now you see everything's rallying, and you still got your safe haven areas. So you still would be better to be in safe haven areas since that October peak than these other areas. But now as we come off of these lows from October the 24th on, so we'll come over here to December 24th, excuse me, on, you can see, so here's the 24th. From that point, your communication services, discretionary. Technology had a little bit of a decline here this week, and it bounced back up nicely, but it's lagging behind because of that decline. It was originally doing very well. Financials, and look at energy, all these beaten up areas, all rallying the most from that Christmas Eve low point. All right, so if we want to take advantage of this rally, at least in the short term, right? We're not looking for a big, strong upward trend, but if we want to take advantage of the rally of the market towards resistance areas in the short term, you can see a stock like Electronic Arts, which has been so beaten up, and in that discretionary area, kind of technology, even though I believe it's actually in the communication services area now, and this gaming area. Regardless, it kind of fits all those modes, right? All in those sectors that do well when we're coming up off of extreme lows. You can see the breakout move it's had towards its top Bollinger Band, getting up here. You can see close to about 85%. After having been below the moving average for so long, the exponential. In fact, you only had a little brief foray up above it here in September. The rest of this whole time it's been really bearish, and a little bit of a breakout move. If you look at the 3 green arrow chart on Electronic Arts, you can see we had 3 green arrows today. It's been a relatively sideways trend over the last couple of months here. Slight decline, obviously, being below the moving average. But 3 green arrows today with the spike in volume. You can see it on an average on a if you break out those lines, the MACD itself is even close to crossing above zero. The 2 lines are close to crossing above zero. The stochastic's getting above the midway point. If you look at the DMI, EA, and then we bring up all those other DMI indicators, and you can see the DMI. First of all, the positive, which has been below 20 for so long. In fact, both these lines looking close to crossing, with both of them below 20, is a good sign actually for a sustained trend. We don't want to bank on that because the broader market's not looking to start a sustained trend here yet that we know of, right, based on what we've seen. But you do have a positive oscillator now, and you also have a jump in the stochastic extremes. So when you have both those aligned going in the same direction, it's a positive development, especially with the closer crossover that you're seeing on the indicator. In fact, you actually do have the crossover by a smidgen. That's why that's actually positive there. So a lot of technical indicators. You've got if you look at the 200-day, where we're at towards the 200-day moving average, we are actually close to its 50-day moving average. So we don't want to be aggressively bullish here, but we want to take advantage of any short-term bullishness the market may provide it, especially with how wide the gap is between these two, the 50 and the 200-day moving average. A lot of gap in there to fill. on the S&P, and you can see how it's kind of hitting some support right around 80. So we can look at selling a put, selling that 80 put, buying the 75 for protection, get a pretty decent credit and decent odds of that sustaining out. You get $136 out of it, depending upon where you get filled in. You were willing to give up up to $136 to get it. We want a position size around $364 loss. We don't want to take that loss. We want to get out with $136 if possible, which would be down to 75.60. So that puts, right around this area is how far we'd be willing to let it go down. So pretty much it would have to nullify the breakout that it's had above these this moving average, and then get down closer to its lower Bollinger Band, which probably by then will start to rise at that point. So that will let us know when to take a small loss and then move on to something else. But of course, if we can get not the full 136, but about $67 in that area. If we can get up to here around this 92 area, that would be right in this spot, and that number will come down as time passes. Then we can get 50% of that max gain quickly, hopefully, as the market continues this little short-term pop, and then get out with that gain and move on to something else. So that wraps us up for today, and now I want to hear from you. Remember to participate in our Market Outlook forums on MarketScholars.com. There's a link above our video in the blog that will take you there. You have to subscribe, but you can do that for free. Also on our blog post, you shall see that image to be able to do that. Take you to the page where you can do that. Very easy, straightforward process. Thank you very much for watching our videos tonight, and as always, I hope you all have a great weekend, and we'll see you all on Monday. All right, goodbye, everybody.